In the previous lesson, we have introduced the forward contract and gave a forward price formula under the assumptions that the underlying asset earns no income and has no storage cost. In this lesson, we will see how the forward price would be affected without these two assumptions. First, let's consider the case when the underlying asset earns predictable income. Let I denote the present value of the income, then its projected future value at delivery is I divided by the discount factor. Since the income earned before the delivery date goes to the seller of the asset, we have the following equation. The forward price F0 plus the projected future value of I equals the projected future value of the current price S0. Rearranging the equation, we obtain the forward price formula when the underlying asset earns predictable income. A typical example of such forward contracts can be a forward contract on a dividend-paying stock. Suppose a stock with a current price of $50 pays a $1 dividend every 3 months. Given the term structure of interest rates with continuous compounding, what is the forward price for a 10 months forward contract on this stock? Throughout the 10 months, the stock will pay dividends 3 times at month 3, month 6, and month 9 respectively. Let Ri be the annualized I month interest rate. We get the present values of the 3 dividend payments. Subtract them from the current stock price $50 and divide by the discount factor from now till month 10, we obtain the forward price F0. In this example, the stock pays discrete dividend. Next, let's consider the case when the underlying asset pays continuous dividend. Let Q denote the continuous dividend yield rate. Then the growth rate of the asset price is reduced by Q. And thus, the forward price is given by S0 times exponential R minus Q times T. After analyzing the case of asset with income, let's move on to the case of asset with carrying cost. Suppose for a particular forward contract, the delivery date is M periods into the future, where each period is H years. This is illustrated by the timeline below. Furthermore, assume that the underlying asset has a carrying cost of Ck per unit in period K, payable at the beginning of each period. Let dKm denote the discount factor from year Kh to year Mh. Then the projected future value at year Mh for each cost incurred at period K is Ck divided by the discount factor from K to M. Since the carrying cost is paid by the investor who holds the short position of the contract, as the asset is not delivered yet, we have the forward price F0 is equal to the sum of the projected future value of the underlying asset and that of the carrying costs for all the periods. Rearranging the equation, it is easy to see that the current spot price S0 is the discounted future price minus all the discounted future carrying costs. The proof of this formula is similar to the previous no arbitrage argument, but with a slight modification. The investor who holds the short position of the contract will need to borrow cash of amount Ck at time Kh to finance the carrying cost. Now let's take a look at an example of a forward contract on sugar. Assume the current price of sugar is 12 cents per pound, with carrying cost 0.1 cents per pound per month to be paid at the beginning of each month. Given the interest rate is 9% per annum, with monthly compounding, what is the 5 months forward price of the sugar? First, given that the interest rate is 9% per annum with monthly compounding, The interest rate per period is 0.0075. Thus, the projected future value of the current spot price is 12 times 1.0075 raised to the power of 5, and that of the carrying cost for each period k is 0.1 times 1.0075 raised to the power of k plus 1. Summing them up, we get the 5 months forward price, which is 12.97 cents per pound. Another typical example of asset with income is treasury bond. Assume a treasury bond with face value $10,000. A coupon of 8% paid semi-annually is currently selling at $9,260, where the previous coupon has just been paid. If the interest rate is 9% per annum with semi-annual compounding, what is the 1-year forward price of this bond? Let's first draw the timeline. Since the previous coupon has just been paid, there will be 2 coupons before delivery, each of $400. The interest rate per period is 0.045. Thus, the 1-year forward price of this bond can be calculated as follows. As a summary, in this lesson, we have learned to determine the forward price of an asset with income or storage cost. However, the market is always much more complicated than our simple models, and that the true forward price does not coincide with our prediction using the formula introduced earlier. We will briefly talk about this in the next lesson.